Disclaimer: all information in this video is meant for educational and entertainment purposes only. Before relying on this information, think about your situation and seek professional advice. Before making any decision, you should double-check the nature of any product or service, including its legal status and relevant regulatory requirements, and consult the relevant regulators' websites. When you invest in the stock market, you're basically putting your money into companies with the hope of making more money in return. It's exciting because you could end up with more cash than you started with. But there are so many different ways to do it that it can be tough to decide where to put your money. Two popular options are exchange-traded funds, ETFs, and blue-chip stocks. In this video, we'll talk about the good and bad sides of investing in ETFs and blue-chip stocks so you can make a smart choice about where to invest your money. Make sure you watch this video to the end. If you're new to the Invest Easy YouTube channel, make sure to like this video and subscribe to this channel for more tips and tricks to financial freedom. Before we go into the details, let's have a brief overview of what ETFs and blue-chip stocks are and how they work. ETFs, or exchange-traded funds, are investment funds that trade on stock exchanges, just like individual stocks. These funds are set up to follow the ups and downs of a particular index, a certain part of the market, or a specific type of investment. So when you invest in an ETF, you're essentially getting a little piece of a bunch of different investments all at once, without having to buy each one separately. One really great thing about putting your money into ETFs is that they help spread out your investments. Instead of putting all your money into one stock, ETFs let you invest in lots of different ones at once. This is like not putting all your eggs in one basket. It helps lower the chance that you'll lose a lot of money if one stock doesn't do well. This is especially good for people who are just starting to invest and might not know a lot about picking individual stocks. Another advantage is the flexibility that ETFs provide. Unlike mutual funds, which can only be bought or sold at the end of the trading day, ETFs can be bought and sold throughout the trading day, just like individual stocks. This allows investors to take advantage of intraday price movements and implement various trading strategies. Also, ETFs usually charge you less money compared to mutual funds. This is because ETFs don't need active managers to run them like mutual funds do. Instead, they just try to copy the performance of an index. Because of this, they have lower fees. When you pay less in fees, you get to keep more of the money you make from your investments. ETFs have good sides and bad sides, just like anything else. One big downside is that they can be affected by how the stock market is doing. Basically, if the stock market goes up or down, the value of the ETF goes up or down too. This happens because ETFs follow the performance of a certain group of stocks, so if those stocks do badly, the ETF does too, even if some of the individual stocks are doing okay. Some ETFs are harder to buy or sell quickly because not many people are trading them. This is especially true for smaller or specialized ETFs, so if you're interested in these less popular ones, it might be more expensive to buy or sell them because there aren't as many people trading them. Before you put your money into ETFs, it's important to really know what you're investing in. If you don't understand what the ETF is all about, you could end up with investments that don't match what you're trying to achieve financially. Blue-chip stocks are shares of well-established companies that have a long history of stable earnings and a reputation for reliability. These companies are typically leaders in their industries and are considered to be financially sound. Examples of blue-chip stocks include companies like Apple, Microsoft, and Coca-Cola. Investing in blue-chip stocks is like putting your money into big, reliable companies that have been around for a long time and have a good history of success. These companies don't usually swing wildly up and down in value like smaller, riskier stocks might. So if you're someone who wants to keep your money safe and not take big chances, blue-chip stocks can give you a sense of security and calmness. Another good thing is that you might get money just for owning certain stocks. Big, reliable companies often give out regular payments, called dividends, to the people who own their stocks. This can be like a steady paycheck for investors who rely on income from their investments, especially when interest rates are low. Also, blue-chip stocks are often considered to be a safe haven during market downturns. Investors tend to flock to these stable, reliable companies during times of economic uncertainty, which can help mitigate losses in a portfolio. Blue chip stocks are like the big, solid companies that have been around for a while. They're known for being stable and sometimes paying out dividends, which are like little rewards to shareholders. But there's a catch. Because these companies are already so big and established, they don't usually grow as fast as smaller, newer companies. So while blue chip stocks are safe bets, they might not make your money grow as quickly as riskier investments. One more downside is the big starting cost. Blue chip stocks are usually more expensive because they're well known for being reliable. This can make it tough for regular people with not much money to buy a variety of these stocks and spread out their investments. Even though blue chip stocks are usually seen as safer investments compared to riskier ones, they can still lose value when the overall market goes down. This means that even if you invest in blue chip stocks, you might still end up losing money when the market isn't doing well. So it's important for investors to be ready for this possibility. Now that we have explored the pros and cons of both ETFs and blue chip stocks, let's compare the two investment options side by side. When you diversify with ETFs, you're spreading out your investments to lower risk. ETFs let you invest in lots of different things, like stocks or bonds, all at once. This means if one thing isn't doing well, it's not a big deal, because your money is spread out. But if you just invest in one big, well-known company like blue chip stocks, all your money is tied to how well that company does. If that company hits a rough patch, you could lose a lot. In terms of liquidity, both ETFs and blue chip stocks are usually pretty easy to buy and sell quickly. But sometimes certain types of ETFs might not be traded as much, which can make it harder to buy or sell them at the exact price you want. When considering costs, ETFs often have lower expense ratios compared to mutual funds. Blue chip stocks, on the other hand, may have higher trading costs due to the premium pricing. It's essential to consider both expense ratios and transaction costs when evaluating the overall cost of investing. Another factor to consider is your investment goals and risk tolerance. If you want steady returns and some extra cash from dividends, blue chip stocks may be more suitable for you. But if you want to spread out your investments and have the freedom to switch things up easily, you might prefer ETFs. Basically, when it comes to deciding where to put your money, whether it's in ETFs, which are bundles of different investments, or in blue chip stocks, big reliable companies, it depends on what you want to achieve financially and how much risk you're comfortable with. Sometimes it's smart to have a bit of both in your investment plan so you can make the most of what each one offers. Just think about what suits you best and go from there. Investing in the stock market can be an exciting and rewarding journey. ETFs and blue chip stocks are two popular investment options, each with its own set of pros and cons. For you to figure out which is best for you, think about what you want to achieve with your investments and how much risk you're comfortable with. Also, it's important for you to remember some helpful tips along the way. Whether you decide to go with ETFs, blue chip stocks, or a mix of both, it's crucial to stick to your plan, keep learning about investing, and focus on your long-term financial goals. That's it for today. Make sure you invest wisely and watch your investments grow steadily. Let me know if you found this video helpful. Don't forget to subscribe and hit the bell to receive all the updates. Invest Easy YouTube channel has got you covered. Also, make sure to leave a comment below if you have any questions about this video. See you next time.